Understanding Irrevocable Life Insurance Trusts and their administration. Introduction. In this article, we will explore the complex world of irrevocable life insurance trusts, ILITs, and delve into the details surrounding their administration. Although ILITs may seem straightforward at first glance, they involve intricate considerations and unique challenges. We will discuss the importance of professional management for these trusts and shed light on the issues that may arise in this area. Exploring Irrevocable Life Insurance Trusts. An Irrevocable Life Insurance Trust, ILIT, is a trust specifically designed to hold life insurance policies. Its purpose is to separate the life insurance policy from the insured individual's estate, which can be beneficial for estate tax purposes. Let's explore some essential points related to ILITs and their administration. Determining the need for an ILIT. From a functional standpoint, the first step is to assess whether you have an estate tax problem. If an individual is not subject to the estate tax and control over the policy is not an issue, then a trust may not be necessary. However, if there is an estate tax concern, establishing an ILIT becomes a sensible solution to safeguard the policy from estate tax implications. Advantages of an ILIT. ILITs offer several benefits, including 1. Estate tax planning *. By placing the life insurance policy inside the trust, the death benefit is excluded from the insured individual's estate, potentially reducing estate tax liability. 2. Control over proceeds *. Trusts can provide control over how the insurance proceeds are used and dispersed, making them an attractive option for those who wish to direct how their wealth is distributed. Funding the ILIT. Funding an ILIT can be accomplished by either purchasing a new life insurance policy through the trust or transferring an existing policy into the trust. Transferring an existing policy triggers a 3-year rule for the transfer, which affects the estate tax treatment. Complex trusts and gift tax considerations. ILITs are often established as complex trusts, meaning they do not distribute all their income annually. While this allows for certain benefits, such as covering premiums with the annual gift tax exclusion, it also raises gift tax considerations. Some key points to understand. Complex trusts do not qualify for the annual exclusion unless they meet specific requirements, potentially leading to gift tax implications. Special exceptions exist for certain trusts, like minors' trusts and crummy trusts, utilizing the crummy power. Crummy trusts derive their name from a landmark legal case and are frequently used in conjunction with ILITs to facilitate annual exclusions for beneficiaries. The annual exclusions can be multiplied by the number of beneficiaries with the right to withdraw funds under the crummy power. Ensuring proper ILIT administration. To ensure the proper administration of an ILIT, several critical factors must be addressed. Let's explore these factors and their significance. 1. Administrative, tax, and investment issues. Administering an ILIT involves handling complex administrative, tax, and investment matters. Key considerations include documenting the trust and ensuring compliance with legal requirements, properly managing investments, treating the life insurance policy as an investment asset, addressing tax-related concerns and potentially taking advantage of tax rules. 2. Policies and procedures. Having well-defined policies and procedures in place is crucial for ILIT administration. These guidelines help ensure all team members understand their roles and responsibilities and enable smooth operations. 3. Professional management. Due to the intricacies involved in managing ILITs, seeking professional assistance from corporate trustees or other qualified experts can be highly beneficial. Professionals are well versed in the nuances of ILIT administration and can help navigate potential challenges effectively. Conclusion. Irrevocable life insurance trusts present unique opportunities for estate planning and tax management. By understanding the need for an ILIT, its advantages, and the complexities surrounding its administration, individuals can make informed decisions regarding their financial future. Seeking professional advice and establishing comprehensive policies are key steps toward maximizing the benefits of an ILIT and securing a stable financial legacy. Understanding the crummy power and its impact on trust administration. Introduction. In this article, we will delve into the intricacies of the crummy power and its significant role in the administration of trusts. The crummy power is a valuable tool used to leverage the annual gift tax exclusion, providing beneficiaries with the right to withdraw funds contributed to the trust for a limited period. We will explore how this power can affect trust funding and management. Explaining the crummy power. The crummy power is named after the landmark legal case /Crummy v. Commissioner of Internal Revenue Service. It allows beneficiaries of an irrevocable trust to exercise their right to withdraw funds contributed to the trust, which qualifies those contributions for the annual gift tax exclusion. Key points about the crummy power include: beneficiaries have a limited window, usually 30 days, to withdraw the contributed funds. The power is not tied to the premium paid for insurance but to the total contribution amount to the trust. Leveraging the annual gift tax exclusion. The crummy power can have significant implications when it comes to the annual gift tax exclusion. Contributions made to the trust can qualify for the annual gift tax exclusion, avoiding the need to utilize the lifetime exemption. The exclusion amount can be multiplied by the number of beneficiaries who have the right to withdraw, maximizing the tax-saving potential. Administrative considerations. While the crummy power is a valuable tax planning tool, its implementation involves certain administrative aspects. #1. Notice of the crummy power. Beneficiaries must be notified in writing about their right to withdraw funds from the trust. The notice should contain the necessary information to inform them adequately. Some points to consider. The notice should be sent via certified mail or with a return receipt requested to ensure delivery and create a paper trail. The language in the trust document should clearly outline the right to withdraw and the time frame for exercising this power. #2. Lapse of the withdrawal right. After the designated time period, usually 30 days, the withdrawal right will lapse automatically. Properly documenting this lapse is essential, and the trustee must ensure compliance with the terms specified in the trust. #3. Frequency of notifications. The trustee should send notifications for each contribution made to the trust to keep beneficiaries informed of their right to withdraw. Determining the frequency of these notices is crucial to avoid unnecessary administrative burdens. #4. Complex trust considerations. If the trust is a complex trust that does not pay out all its income annually, the crummy power may not qualify for the annual exclusion. Proper structuring of the trust is essential to optimize its benefits. Conclusion. The crummy power is a valuable tool in trust administration, allowing contributions to qualify for the annual gift tax exclusion. However, its implementation requires careful attention to administrative details to ensure compliance with legal and tax requirements. By understanding the nuances of the crummy power, trustees and beneficiaries can optimize the tax-saving potential of irrevocable trusts and navigate the complexities of trust administration effectively. The crummy power, understanding its role in trust administration. Introduction. In the realm of trust administration, the crummy power holds a significant role in leveraging the annual gift tax exclusion and minimizing estate taxes. This legal provision allows beneficiaries of an irrevocable trust to withdraw funds contributed to the trust within a specific time frame, making these contributions eligible for the annual gift tax exclusion. In this article, we will delve into the intricacies of the crummy power, its benefits, and how it affects trust management. Explaining the crummy power. The crummy power derives its name from the landmark case /Crummy v. Commissioner of Internal Revenue Service. It enables beneficiaries to exercise their right to withdraw contributions made to an irrevocable trust for a limited period, typically 30 days. This withdrawal right allows those contributions to qualify for the annual gift tax exclusion, making it a valuable tool for tax planning. Leveraging the annual gift tax exclusion. The crummy power serves as a mechanism to maximize the benefits of the annual gift tax exclusion. Contributions made to the trust with the crummy power are eligible for the annual gift tax exclusion, reducing the donor's taxable gifts. The exclusion amount can be multiplied by the number of beneficiaries, enhancing the tax-saving potential for wealthy families. Addressing conflict of interest. While the crummy power may seem like a conflict of interest, case law supports its legitimacy. The same person can act in different roles within the trust arrangement, such as a parent making contributions and acting as a fiduciary representing the interests of the child beneficiary. These distinct roles are legally recognized and do not invalidate the crummy power. Contingent beneficiaries and withdrawal powers. The crummy power can be extended to contingent beneficiaries, providing them with the right to withdraw funds as well. This approach can further enhance the utilization of the annual gift tax exclusion by creating multiple withdrawal powers for beneficiaries at different generations. Administrative considerations. Effectively implementing the crummy power requires attention to administrative details. ###1. Notice of the crummy power. Beneficiaries must receive written notice of their right to withdraw funds from the trust. The language in the trust document should clearly outline the withdrawal right and the time frame for exercising it. Proper documentation of the notice is essential. ###2. Availability of funds. To ensure compliance, it is advisable to have the funds available for the 30-day withdrawal period. Avoid workarounds that may compromise the withdrawal right's validity and timing of premium payments. ###3. Ownership and fiduciary roles. To prevent inclusion in the settler's estate, the trustee should be someone independent of the settler. Retained powers over the trust by the settler may result in estate tax implications. ###4. Income tax implications. Most crummy trusts are considered grantor trusts for income tax purposes, meaning the grantor is responsible for income tax on trust earnings. Conclusion. The crummy power is a valuable tool for optimizing gift tax planning and minimizing estate taxes. By leveraging this power, trust creators can make contributions that qualify for the annual gift tax exclusion while ensuring beneficiaries receive necessary notice of their withdrawal rights. While administering crummy trusts requires attention to administrative details, the benefits they offer in terms of tax savings make them a popular choice for wealthier families seeking to protect their assets and preserve their legacy. Understanding crummy power, an essential aspect of trust administration. Introduction. In the realm of trust administration, one critical aspect that plays a significant role in tax planning is the crummy power. This legal provision allows beneficiaries of an irrevocable trust to withdraw funds contributed to the trust within a specific time frame, making these contributions eligible for the annual gift tax exclusion. In this article, we will delve into the intricacies of the crummy power, its benefits, and its implications on income tax and generation skipping tax. The crummy power, a tax planning tool. The crummy power derives its name from the landmark case /Crummy v. Commissioner of Internal Revenue Service. It enables beneficiaries to exercise their right to withdraw contributions made to an irrevocable trust for a limited period, typically 30 days. This withdrawal right allows those contributions to qualify for the annual gift tax exclusion, making it a valuable tool for tax planning. Income tax considerations. The crummy power creates an intentionally defective grantor trust scenario. While the contributions are out of the grantor's estate for estate tax purposes, they are still treated as the grantor's income for income tax purposes. This intentional setup allows the grantor to pay income tax on trust earnings while reducing the overall estate tax burden. The trust is considered a grantor trust for income tax purposes if the crummy power is attached to an individual beneficiary. The grantor remains the income taxpayer during the period when the withdrawal right is exercised. Managing taxable lapses over 5/5. An important consideration is the taxable lapses over 5/5 rule. This rule states that if the lapse of a general power of appointment exceeds the greater of $5,000 or 5% of the trust, it can trigger a taxable gift. To address this issue, attorneys employ different methods. Limiting the withdrawal amount to the lesser of the annual exclusion or the 5/5 amount. Creating an incomplete gift by granting a limited power appointment to a sole beneficiary. Using a hanging power, delaying the lapse to a year when no taxable gift will occur. Administrative considerations. Effectively implementing the crummy power requires attention to administrative details. Ensure beneficiaries receive written notice of their right to withdraw funds from the trust within the 30-day period. Have the funds available for the withdrawal period to maintain compliance. Appoint an independent trustee to prevent the settler's estate's inclusion in case of retained powers. Understand the implications of taxable lapses over 5x5 and choose the appropriate method to address them in the trust document. Generation skipping tax implications. While the crummy power optimizes gift tax planning, it may affect generation skipping tax, GST, considerations. Irrevocable trusts generally do not qualify for the GST annual exclusion. Two key requirements for the GST annual exclusion are: 1. The trust must be a direct skip, meaning all beneficiaries are direct skip persons. 2. The trust cannot have any other beneficiaries who are not direct skip persons. Most crummy trusts are not direct skip trusts due to multiple beneficiaries or a mix of direct and non-direct skip persons. This means they may not qualify for the GST annual exclusion. Conclusion. The crummy power is a powerful tax planning tool in trust administration, allowing contributors to leverage the annual gift tax exclusion and reduce their estate tax burden. However, its intentional defective grantor trust setup and complexities surrounding taxable lapses over 5x5 require careful attention. By understanding the nuances of the crummy power and ensuring proper administration, trustees can effectively implement this valuable strategy to benefit beneficiaries and minimize tax liabilities. Understanding the crummy power, maximizing tax planning and trust administration. Introduction. In the realm of trust administration and estate planning, the crummy power is a powerful tool that allows contributors to take advantage of the annual gift tax exclusion while strategically managing the generation skipping transfer tax. This legal provision enables beneficiaries of an irrevocable trust to withdraw funds contributed to the trust within a specific time frame, qualifying these contributions for the gift tax annual exclusion. In this article, we will explore the intricacies of the crummy power, its implications on gift and estate taxes, and the opportunities it presents for strategic tax planning. The crummy power, an overview. The crummy power derives its name from the landmark case /Crummy v. Commissioner of Internal Revenue Service. It is a provision that allows trust beneficiaries to exercise their right to withdraw contributions made to an irrevocable trust for a limited period, usually around 30 days. By giving beneficiaries the power to withdraw these contributions, the contributions become eligible for the annual gift tax exclusion, making the crummy power a valuable tax planning tool. Gift tax and crummy power. The crummy power allows contributors to leverage the annual gift tax exclusion effectively. By making contributions to the trust and allowing beneficiaries to exercise their withdrawal right, these contributions become considered /present interests and qualify for the annual gift tax exclusion. This can be especially advantageous when the trust has multiple beneficiaries, as each can benefit from the gift tax exclusion. Income tax considerations. While the crummy power optimizes gift tax planning, it may also impact income tax considerations. The trust is considered a grantor trust for income tax purposes, even though the contributions are removed from the grantor's estate for estate tax purposes. This intentional setup allows the grantor to pay an income tax on trust earnings, effectively reducing the overall estate tax burden. Managing taxable lapses over 5x5. One significant challenge with the crummy power arises from the taxable lapses over 5x5 rule. If the lapse of a general power of appointment exceeds the greater of $5,000 or 5% of the trust, it may trigger a taxable gift. To address this issue, attorneys use various methods, including limiting withdrawal amounts and creating incomplete gifts. Maximizing generation skipping tax benefits. A strategic approach to trust planning involves understanding the rules surrounding generation skipping transfer tax, GST, and the annual exclusion. By carefully crafting the trust document, trustees can create unique arrangements that qualify for both the gift and GST annual exclusions. This strategy can be particularly beneficial for trusts with multiple beneficiaries, enabling the transfer of assets to successive generations without depleting GST exemption. Trustees' fiduciary responsibility. As a trustee, one must approach the investment decisions within the trust, including the purchase of life insurance, with utmost care and consideration. The trustee's responsibilities include conducting thorough investment analysis and decision-making processes, just as with any other investment within the trust. Documenting the rationale behind investment decisions, including the purchase of life insurance. Ensuring that life insurance purchases align with the overall goals and objectives of the trust. Conclusion. The crummy power presents a unique opportunity for contributors and trustees to optimize gift and estate tax planning within irrevocable trusts. By strategically managing contributions and leveraging the annual gift tax exclusion, it is possible to benefit multiple beneficiaries while minimizing tax liabilities. Additionally, understanding the interplay between the crummy power and generation-skipping transfer tax rules allows trustees to create arrangements that maximize tax benefits for successive generations. As trustees navigate these complexities, adhering to fiduciary responsibilities and documenting investment decisions becomes crucial for successful trust administration.